Hello guys, today I want to talk about one of the important concepts in forex trading, right? Which is the external liquidity and the internal liquidity, right? So let's go there. So in a swing or high or in a swing low, there's external liquidity and there's internal liquidity. So let me show you before a liquidity turn into a break of structure, it was already standing there as external liquidity, right? You understand? So this is the external liquidity, external liquidity. You understand? This place is the external liquidity, external. You understand? So that is the external liquidity. You understand? External liquidity, right? So this place is the internal liquidity. You understand? The internal liquidity. You can call it IL. Yes, internal liquidity. So the idea is that once price move and take out the external liquidity, it has to come back and take out the internal liquidity as well. You understand? Price will not just, essentially price hunt the liquidity. That is what you have to keep in mind. Once you discover that, oh, this could be the internal liquidity, there's no point putting your stop loss exactly at that range, because if you think your stop loss will come to the price will come to this place and start going up, you may be setting up yourself for a trap. You understand? And that is why it is very advisable of you to always put your stop loss below, a little further away from the internal liquidity, so that once the price come and trigger off the internal liquidity and start going to your direction, it will not be used as the liquidity. You understand? You understand? So that is how to essentially do this thing. You want to make sure that you are sorry, you want to make sure that you are trading in agreement with the market. You understand? We have the internal liquidity and we have the external liquidity. That is one. That is the concept I want you to have in mind as you trade the market. You understand? Let me show you on a real chart where you can see this thing. Let me show you. Let me show you. Let me show you. Let me clean all this thing off. You still come back to it if there's a need for it. Understand? So still come back for it. So let's go to the real chart now. This is Euro USD chart, right? This is Euro USD chart. So if you look at the price, before the price change direction, before the market structure shift, the market was moving towards the downside. You understand? So before the market start moving towards the upside, the market first took this break of structure. But the market, after the market take the break of structure, you understand, it doesn't go straight up. You understand? After the market, let's take it from here. Let's take from here. Let me do it from here. This is the place that the market change structure. You understand? We have been trading to the downside, and when then all of a sudden the market change structure here. But once the market change structure here, it doesn't go up immediately. So this now, the structure that the market take out, this previous higher and lower high that the market took out, now becomes the external liquidity, right? You understand? Now become the external liquidity, right? You understand? Then the price push down forward and go for the internal liquidity as well. You understand? That is when the market start pushing towards the upside. You understand? Then break another structure. You understand? So that is how the market move essentially. And on getting to this place, after the market push to the upside aggressively, you discover that the market forms another internal liquidity, which is this place. Market forms another internal liquidity here. And what do you see? The market eventually pulls back to that internal liquidity before aggressively going forward again for the external liquidity, which is this place. So that is how the market moves. So you want to make sure you are trading in the favor of the market. You understand? You don't just jump into the market and start placing your buy or your sell. You want to make sure that you are trading along, you are moving in trading with the liquidity in the market, because whether you like it or not, the market will always go for this liquidity in the market. You understand? The market will always go for this liquidity and hunt them. So you want to make sure you are trading in favor of this liquidity. You understand? The story is not different. Even in this place, look at this place. Look at all this place. Look at this place. The moment the market take the liquidity here, what do you see next? This is it. The moment the market take the liquidity, the external liquidity, yes, the external liquidity here, what happens next? It comes down again for the internal liquidity. And the internal liquidity, sometimes it will not be a previous, it will not be only a previous higher low, you understand? You understand? It will always be a previous higher low. Sometimes it is equally a fair value gap. So this is it. This is the fair value gap that the market left behind. You understand? And the market eventually come into it. You understand? You understand? So this is what I'm trying to say essentially. So let me do it for you guys. You can use fair value gap as your internal liquidity as well. Look at it. Let's use this candle now to demonstrate our fair value gap. So let's copy this. Fair value gap is essentially the gap between three candles, right? You understand? So that is fair value gap for you. So let's make it a little prettier than this, you understand? So we go to here. So this is it. So fair value gap, some of you must have heard about it before now, you understand? But some of you might not have heard about it. It is very simple. It is just the gap between the first candles and the third candle. The gap between their wicks. You understand? Their wick doesn't overlap. So that essentially gives us a fair value gap, right? You understand? That is how a fair value gap is represented here on our chart. You understand? So for a contest, I'm going to change all these things to I'm going to change all this to I'm going to change all of them to green candle, right? So let's change all of them to green candle for contest since we are moving towards the upside. So all of them to green candle, right? Green candle. So that is it. This is the fair value gap. The gap between this candle, right? The gap between the first candle and the last candle. You understand? That is just the fair value gap there. Then what we are talking about is that if price is continuing towards the upside, you understand? So this leg up now will be the break of structure, you understand? And this leg up eventually left a fair value gap behind, right? So this fair value gap now will be our internal liquidity. And you want price to come into it, to trade into it. Even if price is giving you signal that okay, I want to go up, you don't want to fall for it. You want to wait until price return back and eventually clear this internal liquidity, which is the fair value gap. Essentially, in a set of three candles, the gap between the first candle's wick and the third candle's wick. This is the first candle, and this is the third candle. You understand? This is the second candle as well. So you want the price to return to this level and clear the internal liquidity, which is the fair value gap, before you start placing another order for a buy, you understand? Once your confirmation candle is being given to you, you understand? So that is how to trade the market in a logical way. You don't want to be doing it randomly. So I'm going to end the video, and I believe you are going to learn something from this video. If you want to join our Telegram community, it is totally free. You can use the link in the video and join us so that you can learn more from us. Thank you.